talk about Europe. So European leaders today are telling Europe to prepare for war.
The European Union just hit the United States where it hurts hard. A staggering $40 billion retaliatory tariff package is sending shockwaves through major American industries, from manufacturing to agriculture. If you think this won't affect you, think again. From rising consumer prices to potential job losses, the fallout could hit every American household. The cost of everyday goods, from cars to groceries, is already climbing. So what exactly is going on? Stick with me, because what happens next could change everything. What's happening? The trade war between the United States and the European Union has officially escalated. In response to the United States government imposing a 25% tariff on steel and aluminum imports, the European Union has retaliated with a $40.3 billion package of counter tariffs. The economic battle, initially seen as a temporary dispute, has now turned into a full-scale conflict, sending shockwaves through major industries on both sides of the Atlantic. The European Union's strategy is clear: target key American industries that have significant political and economic influence. The newly imposed tariffs will hit multiple sectors, including steel, aluminum, agriculture, and luxury goods. These industries represent major exports for the United States and are essential to its economic stability. By applying pressure on these sectors, the European Union aims to force Washington into reconsidering its aggressive trade policies. One of the most notable targets of the European tariffs is the agricultural sector. American farmers, already struggling with domestic economic challenges, now face new obstacles as European buyers turn to alternative sources for goods like soybeans, corn, wheat, and beef. This could lead to billions of dollars in lost revenue and leave many small and mid-sized farms struggling to survive. The luxury goods sector is also feeling the heat. Products such as whiskey, motorcycles, and high-end fashion brands are now facing tariffs that make them significantly more expensive in European markets. This move is designed to pressure American companies with a strong European consumer base, forcing them to either absorb the cost increases or pass them on to consumers, both of which could damage their market presence. The reaction from Washington was immediate and fierce. The Trump administration condemned the European Union's decision, calling it an unfair retaliation and warning of possible additional measures against European imports. However, European leaders were firm in their stance, stating that if the United States is willing to use economic aggression, then the European Union must defend itself accordingly. But while Washington and Brussels exchange threats, the real damage is being felt in the American industries now caught in the crossfire. Who's feeling the heat? As the European Union's tariffs take effect, American industries that once relied heavily on exports to Europe are now facing severe disruptions. Among the hardest hit are the whiskey industry, the motorcycle sector, and agricultural exports, all of which play a major role in the U.S. economy and have strong political influence. The motorcycle industry is taking a heavy hit. The European Union's tariffs have doubled the price of some American-made motorcycles, including Harley-Davidson, a brand that has long had a devoted customer base in Europe. With demand now expected to decline sharply, companies are considering shifting production outside of the United States to avoid tariffs, an ironic turn of events considering that the original tariffs were meant to protect American manufacturing. In the agriculture sector, the situation is even more dire. Soybean and corn farmers have already suffered from the ongoing trade disputes between the United States and China, and now they are facing a similar crisis with Europe. The European Union is one of the largest buyers of American agricultural products, and with new tariffs in place, European nations are looking to South America, Canada, and Australia for alternative suppliers. This is a devastating blow to American farmers, many of whom were already struggling with rising production costs, unpredictable weather, and supply chain disruptions. But the economic conflict is not limited to just the United States and Europe. As the trade war intensifies, other nations are being forced to react, some choosing to align with the European Union, while others look to gain leverage over Washington. The global fallout, the repercussions of the United States-European Union trade war, are spreading far beyond these two economic giants. Countries like Canada, China, and Mexico are closely watching the unfolding crisis and taking steps to protect their own economies, or in some cases, take advantage of the situation. Canada has wasted no time in responding. Already involved in a separate trade dispute with the United States, Canada has expressed support for the European Union's actions and has begun strengthening its trade agreements with European nations. The Comprehensive Economic and Trade Agreement between Canada and the European Union is now seeing a surge in activity as Canadian exporters look to replace American goods in European markets. China sees an opportunity. As the United States faces increasing restrictions on exports to Europe, China is positioning itself as an alternative trading partner. Beijing has already initiated negotiations with the European Union to expand trade agreements on agriculture, technology, and consumer goods. If successful, this could further weaken the United States' influence in global trade and accelerate the shift away from American economic dominance. Mexico is treading carefully. As one of the United States' largest trade partners, Mexico is in a difficult position. While it has benefited from the United States-Mexico-Canada agreement, Mexican officials are concerned about the long-term effects of American protectionist policies. There is growing speculation that Mexico may seek to strengthen its trade ties with Europe and South America to diversify its economic risks. With multiple countries now responding to the trade war in different ways, the risk of a multi-front economic conflict is growing. If additional nations impose retaliatory tariffs on the United States, the situation could escalate beyond just the European Union and lead to a global recession. But for now, the most immediate effect of this economic war is being felt on Wall Street, where stock markets are reacting to the uncertainty with extreme volatility. The markets react. The financial world has not been spared from the impact of the trade war. As soon as the European Union announced its $40.3 billion counter-tariff package, U.S. stock markets plunged. Shares of major American manufacturing companies, agricultural exporters, and consumer goods producers saw sharp declines as investors braced for a long and costly trade battle. Companies that rely heavily on exports to Europe, such as Harley-Davidson, General Motors, and Jack Daniels, witnessed immediate losses in stock value. The agriculture sector also took a major hit, with European buyers looking elsewhere. Agricultural commodity prices dropped, affecting the bottom lines of farmers and food exporters. Meanwhile, investors in the steel and aluminum industries are facing increasing pressure as production costs rise and demand slows. As the trade war continues, investors are adjusting their strategies. Many are moving money into safe haven assets like gold and bonds, while others are shifting investments toward markets less exposed to the US-EU conflict. The longer this economic uncertainty continues, the more likely it is to trigger broader market instability and possibly push the global economy closer to recession territory. With financial markets in turmoil and businesses scrambling to adjust, Americans are already feeling the effects of the trade war in their daily lives. The rising cost of goods. As the European Union and the United States continue their economic standoff, prices on a wide range of goods are rising at an alarming rate. Consumers are seeing the effects firsthand as the cost of food, household products, and even electronics surges. Imported goods from Europe, which many Americans rely on, are becoming more expensive due to tariffs. Luxury brands, including fashion items, cars, and wine, are now priced significantly higher than they were just a few months ago. American consumers who regularly buy European products are starting to feel the pinch, but the biggest impact is being felt in essential goods. The European Union's tariffs have targeted key agricultural exports from the United States, making it more difficult for American farmers to sell their products overseas. This, in turn, is reducing supply and driving up prices at home. The cost of dairy products, fresh fruits, vegetables, and meats has increased as farmers struggle to balance their losses. Inflation, which was already a concern for many Americans, is now being fueled by the trade war. Higher tariffs mean higher costs for businesses, and businesses inevitably pass those costs on to consumers. Major retailers have already warned that prices on groceries, home appliances, and cars will continue to rise if the trade dispute is not resolved. Beyond price hikes, some products are simply disappearing from store shelves. Small businesses that rely on European materials are struggling to keep up with demand, with some having to cut production or even shut down entirely. Meanwhile, car dealerships are reporting delays in receiving European-made vehicles, further driving up prices for those looking to buy a new car. As costs continue to rise, public frustration is growing. Many Americans feel trapped, unable to afford the basics as their purchasing power diminishes. What started as a dispute between governments has now become a direct financial burden on millions of families. With consumer frustration growing, the political consequences of the trade war are becoming impossible to ignore. The political fallout. The economic turmoil caused by the trade war is now one of the most divisive issues in Washington. The once theoretical debate over tariffs has transformed into a national crisis, with both political parties clashing over how to respond. Congress is now deeply divided. Some lawmakers argue that standing firm against the European Union is necessary to protect American manufacturing and keep jobs at home. They believe that negotiating from a position of strength is the only way to force better trade agreements. However, others warn that the tariffs are backfiring, damaging American businesses and hurting workers. The situation is further complicated by the upcoming United States elections. Candidates are scrambling to align their messaging with the concerns of voters. With inflation rising and wages stagnating, trade policy is becoming a central campaign issue. Politicians on both sides of the aisle are using the trade war to rally their base, blaming their opponents for the economic hardships caused by the dispute. Meanwhile, business groups and labor unions are also putting pressure on Congress. Industries that once supported protectionist policies are now advocating for a more strategic approach, fearing that the long-term damage could be worse than the short-term gains. Public opinion is shifting rapidly. Polls indicate that a growing number of Americans want the trade war to end, with many blaming Washington for its failure to protect their financial well-being. The question now is whether Congress will take action or remain gridlocked as the crisis deepens. But while Washington remains in political turmoil, the bigger question is whether the United States economy can withstand a prolonged trade war with the European Union. Can America outlast the European Union? The United States is often viewed as an economic powerhouse, but in a prolonged trade war, the question remains, can it outlast the European Union? Both economies are among the largest in the world, but their strengths and vulnerabilities are different. The United States has a dominant tech sector, a strong financial market, and a massive consumer base, while the European Union benefits from a highly diversified economy, extensive trade agreements, and a strong manufacturing sector. Certain United States industries are highly vulnerable to a continued trade war. Agriculture, automotive manufacturing, and consumer goods are all feeling the pressure. If the conflict drags on, American farmers could lose billions in exports, while automakers and retailers struggle with disrupted supply chains. Meanwhile, the European Union is using the trade war to strengthen its alliances with other major economies. Europe is increasing trade agreements with Canada, China, and Latin America, creating alternative markets that reduce its reliance on the United States. The question is not just about who has the stronger economy, it is about who can endure the most damage. If the trade war continues for too long, both sides will suffer, but the United States may face a greater risk of economic decline. As the trade war continues to unfold, the stakes are growing higher by the day. Will Washington find a way to resolve the crisis, or is the worst yet to come? Europe's economic play. When the United States imposed aggressive tariffs on steel, aluminum, and a range of industrial goods, the European Union responded with swift and calculated retaliation. This was not just about protecting European businesses. It was a strategic move to redefine global trade power. The EU's decision to hit back with $40 billion in tariffs was not just a reaction. It was a declaration of economic strength. By targeting key American industries, including agriculture, manufacturing, and luxury goods, the EU sent a message. Europe is not willing to be bullied into economic submission. American whiskey, Harley-Davidson motorcycles, Levi's jeans, and even Boeing aircraft parts were among the many products that faced new tariffs. These were not random selections. They were carefully chosen to hit the U.S., where it hurts the most. Industries with powerful political influence and deep economic significance. One of the EU's key objectives was to protect European manufacturers from unfair competition. For decades, American firms have enjoyed a strong foothold in European markets, selling everything from cars to high-tech equipment. But with the new trade barriers in place, European businesses suddenly found an opportunity to replace U.S. imports with domestic alternatives. This shift could drive billions of dollars in new investments into European industries, particularly in Germany, France, and Italy, where manufacturing is already a dominant economic force. However, retaliation is just one part of the equation. The EU knows that trade wars are unsustainable in the long run. That is why it is now taking proactive steps to forge new economic alliances, ensuring that even if trade with the United States declines, European businesses will have other markets to rely on. Trade diversification comes at a cost. The EU must now deal with the risks of retaliation and economic instability that could arise from its bold stance. Can the EU afford a trade war? While the European Union is taking an aggressive approach in response to US tariffs, the question remains: can it sustain a prolonged trade war? The reality is that while Europe has significant economic strength, it also has weaknesses that could be exploited if the conflict continues. One of the biggest risks is the impact on European businesses that rely on US exports. Many industries within the EU, particularly in Germany and France, have built their success on selling high-end machinery, automobiles, and pharmaceuticals to the American market. If the United States decides to retaliate further by imposing new tariffs on European goods, it could significantly hurt companies like Volkswagen, Airbus, and Siemens, leading to layoffs and economic downturns in key regions. Another challenge is internal division within the EU itself. While countries like Germany and France are pushing for a strong stance against US tariffs, others, such as Hungary and Poland, are more cautious. Some European nations fear that an extended trade war could disrupt economic stability, leading to disagreements over the best course of action. If this division grows, it could weaken the EU's ability to negotiate as a unified force. At the same time, inflation and rising costs are already affecting European consumers. The increased price of imported goods from the US, including agricultural products and luxury brands, could lead to higher living expenses. While the EU has strong social welfare policies in place, prolonged economic disruptions could still lead to public discontent and political instability. As tensions rise, the battle could extend beyond tariffs and trade restrictions. Energy could become the next battleground, the energy factor. If the trade war continues, the European Union has one last major weapon it could use against the United States: energy restrictions. While the current conflict has focused on steel, agriculture, and consumer goods, the EU could escalate the battle by targeting US oil and natural gas exports, a move that would have devastating consequences for both economies. The United States has become a dominant player in global energy markets, particularly in the export of liquefied natural gas to Europe. In recent years, American energy companies have increased shipments of LNG to Germany, France, and the Netherlands, reducing Europe's dependence on Russian gas. But if trade tensions worsen, the EU could impose tariffs or restrictions on US energy imports, forcing American suppliers to seek alternative buyers. The impact would be severe. US energy companies rely heavily on European markets, and any disruption could cause oil and gas prices to plummet, hitting major producers like ExxonMobil and Chevron. Meanwhile, Europe would need to secure alternative energy sources, possibly strengthening ties with Norway, Qatar, or even Russia, which could create new geopolitical challenges. More importantly, energy tariffs could escalate the trade war to an entirely new level. Unlike steel or agricultural goods, energy is a strategic resource that impacts national security. If the EU moves forward with energy restrictions, the United States may view it as an economic attack, potentially leading to even harsher countermeasures from Washington. With tensions at an all-time high, both sides now face a crucial decision: continue escalating or find a way to de-escalate before the crisis spirals out of control. The US' last chance. Washington is now at a crossroads, and the stakes could not be higher. The United States faces two possible paths: de-escalation through negotiation, or full-scale retaliation that could plunge the global economy into deeper turmoil. Both options come with significant risks, but failing to act decisively could lead to irreversible damage. Negotiating a settlement would require the United States to roll back some of its tariffs and find common ground with the European Union. This would help stabilize industries that are struggling with supply chain disruptions, rising costs, and declining export markets. However, any sign of retreat could be seen as political weakness, especially with an election cycle approaching. Policymakers who have built their platforms on economic nationalism might be reluctant to concede, fearing backlash from their voter base. On the other hand, escalating the trade war would be an economic gamble with massive consequences. By imposing even harsher tariffs on European imports, the United States could force the European Union to back down or risk losing key American markets. However, this approach could also backfire, as the European Union has proven its willingness to strike back with targeted countermeasures that could cripple American agriculture, manufacturing, and technology sectors. Additionally, other global players such as China and Canada are watching closely, ready to step in and strengthen their trade ties with Europe at America's expense. The pressure on Washington is not just domestic. Global markets are reacting with growing concern. Investors fear that continued trade tensions will drive inflation higher, slow down economic growth, and destabilize industries dependent on international trade. The International Monetary Fund and the World Trade Organization have both warned that prolonged conflicts between major economies could trigger a wider financial downturn. The next move from Washington will determine the course of this crisis. Will the United States seek diplomatic solutions to prevent further economic fallout, or will it choose to escalate tensions, risking a full-scale economic war? But if the United States is losing ground, who stands to gain from this economic standoff? The next global power shift. Trade wars rarely have clear winners, but in this case, several countries and industries are poised to benefit from the ongoing US-EU conflict. China, Canada, and various emerging economies are capitalizing on the rift, strengthening their positions in global trade. China, in particular, has been quick to seize this opportunity. As the European Union looks for alternative suppliers to replace American imports, China has stepped in to offer competitive pricing on industrial goods, electronics, and raw materials. This not only boosts China's economic influence, but also weakens America's grip on international trade networks. If China and the European Union solidify their trade relations, it could create a powerful economic alliance that challenges U.S. economic hegemony. Canada, already benefiting from a strong trade agreement with the European Union under Comprehensive Economic and Trade Agreement, has seen increased exports in key industries. Canadian agricultural products, energy resources, and manufactured goods are now flowing into European markets at higher volumes, replacing American suppliers who are burdened by tariffs. This could lead to a permanent shift in trade preferences, further marginalizing U.S. exports. Emerging economies such as Brazil, Mexico, and India are also leveraging the situation to expand their market reach. As global supply chains readjust, these nations are positioning themselves as alternative trade partners, offering competitive advantages in agriculture, manufacturing, and technology. The long-term risk for the United States is clear. If global trade flows begin shifting away from American dominance, regaining lost ground will be difficult. Once new trade routes are established, businesses and governments may be reluctant to revert to pre-trade war conditions, even if tariffs are eventually lifted. And if global economic power is shifting, could this trade war trigger something even more dangerous? A financial crisis? The unthinkable. The risk of a full-blown financial crisis is growing as trade tensions continue to escalate. While trade wars alone do not always lead to recessions, the combination of market uncertainty, inflation, and supply chain disruptions can set off a chain reaction that affects global banking systems and investor confidence. If the trade war between the United States and the European Union drags on, we could see increasing volatility in global stock markets. Investors, wary of economic instability, may begin withdrawing funds from key industries, leading to capital shortages and reduced investment. As production costs rise and businesses struggle to maintain profitability, layoffs could become widespread, further weakening economic growth. One of the biggest concerns is the impact on the banking sector. Financial institutions that are heavily invested in industries affected by the trade war could face liquidity crises, leading to tighter credit conditions. This would make it harder for businesses and consumers to secure loans, slowing down economic activity and increasing the risk of recession. Additionally, if inflation continues to rise due to higher tariffs, central banks may be forced to increase interest rates to control price spikes. While this might stabilize inflation, it would also make borrowing more expensive, putting additional strain on businesses and consumers alike. The global economy is deeply interconnected, and disruptions in one region can quickly spread. If the United States and the European Union fail to reach a resolution, the effects could be felt far beyond their borders, potentially triggering an economic slowdown that rivals past financial crises. Is the world heading toward economic chaos, or will cooler heads prevail? The coming months will be critical. Governments, businesses, and investors must decide whether to pursue conflict or cooperation. The outcome of this trade war will not just determine short-term profits and losses. It will shape the future of global trade for decades to come. The stakes couldn't be higher. This trade war isn't just about tariffs. It's about the future of global economic power. Will the United States back down, or will the European Union stand firm? And more importantly, how will this impact your daily life? Let me know your thoughts in the comments. Do you think these tariffs will help or hurt the economy?